Welcome all. Welcome to our Iress live stream. We're just waiting for a few people to sign in. The demand has been actually really high for the session today, so the numbers are ticking up nicely. I think lockdowns really made a difference to the number of people we're getting to attend these events. So it's great to see so many people signing up. While a few more people, because the numbers are still ticking up there, while a few more people are joining, let me firstly introduce myself. I'm Mark Loosemore and I work for Iress. I will be the host of our first Iress live stream. These are events that we're going to be doing every month when we're going to be talking about some topics of interest in the financial services industry and in particular reference to the use of technology. We'll be doing them for the foreseeable future, and hopefully they will be both informal but informative chats, a chance to have maybe a coffee and a biscuit and actually gain some insightful information into the world of fintech. I wanted to sort of describe it almost like ITV's Loosemore's Loose Women, but marketing were horrified at my suggestion of doing that, so we went for the far more professional title of the Iress live stream. Of course, these would be nothing without having the professional people that I've got joining me today, we've got a great team to kick off the first of the live streams, and I'm joined by Ross from Johnston Carmichael and John from Iress, often known as Mr. Flo here at Iress as well, and I'll let them introduce themselves in a few moments. Probably just worth saying up front that while obviously Iress has its own cash flow planning capability with X tools, all of us on this call know some of the other tools out in the market. Iress also integrates with some other good tools like CashCalc and Buoyant in the marketplace. So the conversation today will be generic about cash flow, how to engage cash flow in your business, what's in it for the business, what's in it for the end client, how we actually make it all work seamlessly to get the best for everyone in the value chain. If people are interested in learning more about our particular cash flow tools, there will be a chance to do that on the 7th of July, where you can register for that, and we'll be doing some demonstrations at that point, or just simply email me and I'll make sure that we get you the details of that event as well. But let's get on to the main event though, and we're joined, as I say, by John and Ross. Ross, do you want to first introduce yourself, where you work and what your role is there?
Yeah, sure. Thank you very much, Mark. So as Mark says, my name's Ross Leckridge. I'm a Associate Director and a Chartered Financial Planner with Johnston Carmichael. I'm based in our Edinburgh office, where my role predominantly is client-facing and working with new clients and existing clients of the firm to just help them with their general financial planning needs.
Great stuff. And you've used both X tools and other tools in the past?
That's right, yeah. So I've used a couple of different cash flow systems over the years, and generally, you know, the purpose of them is the same in my experience. They maybe show things in a slightly different way and use slightly different charts, but they get the same point across.
Great stuff. And Mr. Flo, do you want to say a few words about yourself and how you came across Iress?
Yeah, sure. So my name's John Bethell. I'm financial planning by background. I was 20 plus years with a national wealth manager, where we used other cash flow tools, but then we had an opportunity to kind of move into a new generation of cash flow tools. And so I first saw Iress, the Iress tool when it's in Australian dollars and Australian tax, and went on the journey with Mark when I was in the national wealth manager to anglicize that tool and bring it into the UK market. And then about 3 years ago, I moved across to Iress to work more closely with the tool. But my passion is still financial planning, or cash flow in financial planning, and the use of those tools.
Great stuff. Well, that passion is probably a great place to start, because I know you're both quite passionate about cash flow planning. And I guess my opening question to you is why? Why even bother with cash flow planning? What's in it for the client? What's in it for the financial planners themselves? Ross, do you want to kick us off with your thoughts on that?
Yeah, sure. I mean, for me, the biggest benefit of using it is just client engagement. You know, I've been in lots of meetings in the past where clients will come in and they'll tell you their current circumstances and what assets they've got and so on and so forth. And you know, without cash flow planning, it can be a bit more difficult to bring that to life, and I suppose to kind of make it interesting, make it really theirs, if that makes sense. So for me, the big advantage of using it is the engagement that you get from the client. You know, when you take all their information, you pull it all together, you come back with this cash flow model, which really is kind of showing them their financial future, but laid out on screen, you know, to help them really. And that's the moment where sometimes, you know, you get the client that all of a sudden you can see the interest sparking in their face, and they start to ask a lot more detailed questions. And then what would happen if we did this, or, you know, if I didn't do what I said I was going to do in 5 years' time, what might be the impact of that? And so it's getting that buy-in from the client that for me is definitely the biggest advantage. From the financial planner's point of view, it does help to come up with recommendations. You know, I'm always quite careful to explain to clients that, you know, the cash flow model is not going to make the recommendations for us. We've still got to make the recommendations once we've looked at the analysis. But what it does help to do is it helps the planner and the client, I think, to make informed decisions about actions that you could take now and what the potential impact of those actions might be further down the road.
Yeah, it's interesting, isn't it? Because coming back to the bit about the client actually quite enjoys that experience quite often when they're doing involved in a cash flow planning process itself. I remember one person telling me how their first time they'd ever done cash flow planning, and this was going back probably 5-6 years ago that I heard the story. The client came back and didn't just give him a check, but also gave him a bottle of wine for saying thank you for the whole experience, because they'd actually found it quite a rewarding experience in giving them that clarity. And I think it's a different type of relationship that then develops, which is lovely to see. Yeah. John, have you got any thoughts about the benefits? Yeah. Anything you would add on that side?
Absolutely. I mean, I'd echo what Ross has said. I think it is all about that client journey, and it's the client perhaps for the first time understanding what their money means to them. And it changes. I've seen it change relationships with planners, because all of a sudden it's moved away from the minutiae of that investment or whatever, almost comparing it to a kind of a car that they're buying. You know, they're no longer looking at the tweaks on the engine, but they're looking at actually what this car will do for them in their lives. They'll look at what that financial plan will do for them in their lives. And so it becomes much more engaging, and it just infuses them into the process, into the general plan.
Yeah. John, from the financial firm's point of view, is there anything you would add there in terms of how they can benefit?
Absolutely. I think it depends as a firm what you want from cash flow planning. And when I first talk to firms, sort of with my Iress hat on, I do talk to them about what do they want from it, because some firms, it'll be part of their DNA. It'll be part of, this is what we do with every client in every instance, because this is what we do. For other firms, it's more limited. And I think it's important initially for the firms to decide what they want from it, because that then drives what they can get out of it. And so, yes, certainly, on the face of it, when you first start dealing with cash flow planning, I think it increases the advisor's share of wallet, to use an old hackneyed phrase, purely because they tend to trust you more, they open up more information, and they realise that they do need to invest to get that pretty picture they want. They want to retire at that age. This is what they need to do about it. It's very clear. And so, clearly, more funds under management as an initial starting point. But also, I've seen it, as it develops into the DNA of the firm, it becomes part of their process. And what that means is that, say, at review stage, the cash flow can provide the basis of the review document to say, this is where you were, this is where you are now, this is where you need to go, what do we need to talk about? And so from that, it then makes the review process much more fulfilling than, again, trying to decide whether that fund has dropped by 0.5%, should you be selling it. It changes the discussion to being all about the client, and therefore clients tend to engage more in those reviews, keener to book them, which again leads to that stronger ongoing relationship.
And look, there's some great points that I want to come back and talk about the review process in particular later on, because I think there's some really interesting stuff around that. The other thing that I think is quite interesting about the financial firm's point of view, I remember interviewing someone for an article I was writing on cash flow planning, And this person said the big thing for them was the price sensitivity of financial advice became far less. So there's then when we were flogging a product going back some time, presumably, everyone argued about price. When they moved to more holistic advice, price was an issue, but less so. When they got into cash flow planning, people were focused on the outcome of the plan and not how much they were paying for it. And I think that's really important for firms as well. Now, just if I could pause things, there is a question, ability to ask questions as well for the audience. So well, we've got our experts here. If people want to type in questions, please feel free to do so, and we'll try and pick those up as we go through this session. But while the questions, while you think about your questions, the next thing I wanted to talk about was something that Ross, you started to talk about, was how you engage with the client. And one of the things that I hear debated quite a lot amongst financial planning community is how that occurs. Should it be a static report that you print off and you hand to the client, so all the analysis is done and you hand it off, or is it something you'd actually interactively do with the client, you know, maybe not side by side during lockdown, but maybe over a screen, but ideally next to them post-COVID, you know, face to face, working through the plan. What's your view on that?
I'm a firm believer that using it dynamically is far more beneficial for the client, because it allows you to kind of react live time to what the client's saying to you. So you need to be careful with it, because you don't want to be showing them information which is incorrect, because you'll just undermine your authority and you'll lose their trust and buy into it. So you need to spend a little bit of time to build the model and any alternative scenarios that you want to discuss with the client offline, and kind of do that in the back office, and take the time to make sure that you've got everything the way it should be. But once I've got it to that stage, then I much prefer to present that cash flow system live in a meeting with a client. And at the moment, of course, we've got the likes of Zoom and Teams and Skype and so forth that are allowing us to still do that, even though we can't be in the same room as the client. But just by using a screen share, we're still able to bring up the cash flow model that we've built for them and talk them through it. And so you can kind of explain much better with the live model what we're looking at on the screen in a printed.
I think we've lost Ross' sound a little bit. That's one of the joys of COVID. John, I think you're still with us there. So maybe you could add in what you're thinking about how you would interact with clients. Are you seeing your customers using it face-to-face, or are you seeing it as a static report?
I think increasingly people use it dynamically. But I think this all depends on your client. Different clients react in different ways, and some people want the time to look over a paper document. You need to have that available. But increasingly, we're seeing it being developed interactively, and I think the benefit of that is exactly as Ross was saying. You can then reflect the client's concerns. You can show them different pictures and then reflect their discussion, so that it is very much about their objectives rather than about a predetermined course of action that Ross or somebody like yourselves have already defined for them. And okay. That's where you get the engagement.
Okay, great stuff. Now some questions coming in online, so we're going to pop over to some of those questions. The first one was for Ross, but I think you may well have some opinion on this as well, which is, should you charge for a cash flow service, and if so, how much is reasonable, and what are you seeing in the marketplace?
Yeah, I'm back now.
You're back, Ross. Sorry, yeah, we can hear you again. So, Ross, what do you think? Should you charge for the cash flow planning, and if so, what do you think is a reasonable sort of price to charge?
Yeah. Yeah, I think we should charge for it. I think we should be shy to charge for where we're adding value. And for me, this adds a lot of value for the client, you know, and in fact, I think they get more value potentially out of the cash flow planning side of things than they do out of the suitability report that follows later on. So yeah, we charge for it. If we're doing a standalone cash flow model, then the charge can vary anywhere from sort of 1,500 to 3,000, just depending on how complex the model is. So, you know, I'll often use the example with clients that if this is a really simple, straightforward arrangement where you've got a single person with a lump of cash to invest and fairly simple arrangements in the background at the moment, then that might be £1,500. If you've got a couple who've got DB pensions, SIPs, ISAs, and various other more complicated arrangements at the moment, then obviously it's going to take us more time to factor all of that into the model. So then we might charge more like £3,000 to do it. But yes, I think absolutely it's something that we should charge for. And it also separates, you know, what the client's paying for the cash flow from what they're paying for the implementation later on. And so I'll say to clients, you know, you're not obligated to take things any further than this. If you just want us to do a cash flow plan, we'll just do the cash flow plan. But if you then want us to give advice on what products and investments you need to implement that plan, then we're happy to do that, and we'll charge you a separate fee for that stage.
Yeah, and I think it is all about if you're adding value, it's fair and reasonable to get compensated for that. Another question online, and keep the questions coming. There's quite a few coming through. This one is saying, what about the disadvantages that the cash flow plan is dependent on assumptions and will be sensitive to the assumptions? So which assumptions are realistic? Lots of very changeable, and the picture for the client could change a lot as a result. So how do you handle that within building a cash flow plan? How do you manage expectations of the client with that? John, do you have a view on that?
Yeah, I think the first thing I'd say, Mark, on this is I believe that when we're looking at cash flow planning, your base assumptions, things like inflation, should be really long-term inflation assumptions. So they're not ones that you should be tweaking every 3-6 months or whatever, because I don't think that helps the client. You're trying to give a sensible set of assumptions that gives a stable base so the client can see the financial planning unwinding, see the financial planning working for them. Therefore, I'd look for those long-term assumptions. But the key to me in cash flow is your first cash flow is your starting point. It's not your finishing point. And therefore, the power of cash flow is in the repetition. And that will reflect what the performance has been to date on their portfolio, so to speak. And so looking at long-term growth assumptions, long-term inflation assumptions, and then regular update tends to mean that it becomes much less sensitive to changing rates. And the final point is I would always be quite conservative in my assumptions, because I'd much rather tell a client they can retire 2 years early than have to tell them that they can't retire today.
Yeah. Okay. Thank you very much. Another question for either of you. What are your thoughts about the FCA's inspection of cash flow planning, which is not regulated, concerning and being paid for by, say, pensions, which are regulated?
Yeah, well, I'll give you our sort of company view on it, and that is just that, you know, we wouldn't take a fee for cash flow from somebody's pension, because, you know, the advice is not specific just to that pension. It's far more holistic than that, and also we take the company view that we need to charge VAT on cash flow planning, because it's not necessarily automatically financial intermediation, you know, because you don't start cash flow necessarily with the intention to recommend a financial product at the end of that process. Often it does lead to that, but it's not always the starting assumption. So our own view is simply that it's not VAT exempt. It's not necessarily part of financial intermediation. So if we're doing standalone standalone cash flow for a new client, then we will charge them a fee by invoice with VAT added to that, and they'll pay that invoice direct. And then again, you can't have that kind of nice clean break at that point. We can then move into product recommendation and financial intermediation after that. And if that means taking some of the fee from a pension and some from an ISA and some from cash, then we're able to cut that up depending on what we're actually recommended.
Okay, interesting. Thank you very much. Now we have a few specific questions which are probably suited for you, John. What one is, does Iress's cash flow take account of taxation? The current tool they're using can't. So does X tools take account of taxation?
Absolutely. It covers all areas of taxation: inheritance tax, capital gains tax, income tax, agricultural property relief, etc. I think the key for me here is one of the things, and I'm very conscious that we're looking at a generic environment at the moment, but one of the things that I think is important in a cash flow is that you can show your client what the route, why you're recommending what you're recommending, and without having a tax underlay, it's quite difficult to show the real benefits. And so I think that's hugely important.
Okay, and another question: how do you factor in lifetime allowance charge into cash flow forecasting?
The answer is yes, we do, and we can show the charge being taken either from income or from paid out as a lump sum. And so these are all parts of the importance of cash flow. It helps you maybe earlier on in their retirement journey to start making decisions about which way you're going to take the draw down the assets. As a guidance, it gives you an overriding principle which you then reaffirm each year. So yeah, being able to deal with that sort of thing is really important.
Okay, there is a question about what tools Iress provide. If you weren't around at the start of the session, we are having a session on the 7th where we can provide you with more details about the Iress proposition, which is X tools, and we'll include costs there. If you want something more immediate, please email me at mark.loosemore@iress.com. Now, one for yourself, Ross, and I think this is a really good question. I know we've talked about this in the past. Is it feasible to use cash flow planning for all your clients, or do you limit it to those that are more engaged? And a personal question on top of that would be, does the level that you go into with the cash flow planning vary by client, or do you have a house view of the level of that you should go to?
Yes, I think it would be wrong to force clients to do cash flow if they really don't want to, because if they don't want to do it, then they're not really going to get much benefit or value from it. So I think it needs to be kind of led by the client. But I would caveat that by saying, if I just sit down with a new client and I say, okay, well, based on everything you've told me, I'd like to build a cash flow model for you. They're probably not going to know what I'm talking about. They don't really understand necessarily what the output of that might be. And so it would be difficult to expect them to really make an educated decision based on that alone. So where I've had resistance from clients to using it, then I might show them a case study, that we've got pre-built that I can just jump into and say, well, look, this is the sort of thing that we're going to do for you. And I've had clients in the past who haven't necessarily been really that enthusiastic about it to begin with, but again, it's that kind of light bulb moment when you show them their plan that's specific to them, and it factors in all the things that they've been telling you about, giving a deposit to their son for his first flat, or paying for their daughter's wedding in a few years' time, or looking at retirement at 58 instead of 62, and you kind of bring it to life that way. Then again, it's that engagement piece where all of a sudden you've got a client who's really interested in what you've got to say, and that's the moment that I think they kind of get it, and probably they're quite glad that they did go ahead with it. So I would never force a client into it, and maybe for some clients they don't see a lot of value in it, and they just think, I'm never going to run out of money, why would I need cash flow? But cash flow should really be for a lot more than just working out if you're going to run out of money. You could use it just as an estate planning tool if that's what you wanted to do. You have a scenario built where they don't do any estate planning at all, and you can show them what their inheritance tax liability might look like. And you have an alternative scenario built where you said, well, what if you gave away a couple of £100,000 tomorrow. What impact would that have on your lifestyle? If the answer is virtually none, but the inheritance tax bill is much, much lower, then, you know, why wouldn't they want to start thinking about that? So it starts to get clients thinking in the right way, even if it's not just about whether I'm going to run out of money or not.
Okay, interesting. Now, a couple specific ones, I guess, for yourself, John. One was, you kind of touched on a little bit, but how do you cope with taxation in cash flow planning and income tax personal allowance? And does it take account of the LTA position? Are those two that you could pick up?
Yeah, I mean, the answer is absolutely. It's a full income tax calculator, full national insurance, etc. And we differentiate in terms of growth rates between growth and dividend income and interest. But I would just refer back to the session on the 7th. If you want more detail on the Iress cash flow tool and how it works and the depth of the taxation, then just jump on that session.
Okay. Ross, a couple in for yourself around how you would actually charge for annual reviews of cash flow. And again, we've talked a little bit about in the past how you know, is this an annual review, or is this every 3 years? So I would add, what period would you review a cash flow on, and then how do you charge for this? And should that again be separate from separate to the suitability of the products and service that you provide?
Sure. So like most financial planning firms, we've spent a lot of work over the last couple of years segmenting our client bank appropriately, you know, and really working out based on the client profile, what sort of advice do they need from us. And so at the moment, we've got a model whereby clients whose ongoing annual advice charges are more than £3,000 a year, we will provide cash flow planning for them as part of their annual review service. You know, so it's offered to them annually. They don't have to take it up annually. And again, refer back to the last comment that there's no point in forcing somebody to do something they don't feel they're going to get any value out of. So we'll, when we get to the 6 monthly review period, we'll say to the client, do you want us to review the cash flow model? And if the answer is yes, then we'll update the model using current asset values and current incomes and expenditures and all the rest of it, and make it, you know, a step forward from the last time that we did it. If the client says, no, we did this 12 months ago, nothing's changed, everything's as it was, I don't really see the value in doing that, then we can just do an annual investment review where we don't include cash flow planning, and then we'll just revisit that with them again next year. So we do it on a yearly basis. We'll meet the clients twice, once to do a sort of investment review, and then 6 months later to do a cash flow review, unless they don't want it, in which case it just becomes another investment review at that point. And that's included in the annual fee.
Okay, thank you very much. A couple of other ones, and I'm conscious we're coming to the end of our half hour. It's flown by, guys. So thank you very much for all the information and all the questions as well. The one is, what assumptions do you use? I guess maybe this is for yourself, John, and where do you source these? Are they in-house, or they're based on your own views or an external source? And what evidence do we save to support those assumptions? And there's a linked question, I guess, from which is, do we have any views on the growth rate assumptions that should be used, and how are they stress tested and for what degree? John, do you want to take that?
I think that's the nub of the technical side of cash flow planning. I always think with cash flow planning, there's the client interaction, and then there's the back office work, and that's the nub of producing good cash flow. And when we look at assumptions, and I used to write the assumptions document for that National Wealth Manager, it's important you record what your assumptions are and why you've decided that. The FCA can ask to look at that if you are basing advice off the outcome of the cash flow. So while cash flow is not regulated, I think we touched on this earlier with Ross, while cash flow itself isn't regulated, if you're using it to support advice, then they have a right to ask and should be asking. In terms of assumptions, I think it's looking at your investment proposition, whatever that is and however that works, and really I would often look to tie it into the risk profiles. And so as you move through your risk profiles, you're probably increasing your return assumptions, and it's looking at those, bringing them out, seeing what they look like, and then using a sense of looking longer than the 5-year view. These assumptions should be based looking initially over 20, 30 years. And if we're looking at long-term returns, say for equities, you get to the point where you say, well, if I include the last 20 years or the last 30 years of returns to get to a sensible projection level, that will include market setbacks. And therefore, it moves away to an extent from this, what happens if the market crashes. If we're looking at a long-term return, then that will be factored in, and it then becomes actually that market setback is really important in terms of liquidity rather than total return. And so that's where I would come from assumptions, but that's something that I think probably is worthwhile talking about offline if you have particular concerns about that, or you want to discuss that further based on your own situation, because every firm will take a slightly different nuanced view depending on their clients and their investment proposition.
Okay, thank you very much. I've got 2 questions I'm going to try and squeeze in, so they're going to have to be brief answers, I'm afraid. The first one, again, something we've talked about, Ross, in the past, which is, would you recommend updating the client's circumstances during the meeting, or do you do it prior to the meeting?
I would try and do it prior if I can, but again, it's nice to be able to do things dynamically in the meeting if you're able to do so. So if it's a relatively simple, straightforward change, what if I spent an extra $5,000 a year in my retirement, for example? That's something I would try and just jump in and do straight away to show them the outcome. If it's something a bit more complex, like, oh, I've got this DB pension that I forgot to tell you about, I wouldn't try and factor that into the model in front of them.
Yeah, and I know that we're certainly seeing a desire to use online fact finds and stuff to pre-populate some stuff, and I know we've had a debate in the past about how much of that data you'd want to collect remotely, because sometimes some people want to get the client to fill that data in to make it efficient. Some areas like goals and needs, you may want to have a one-to-one conversation with, and I think that's an interesting debate that will continue. Maybe we'll visit in one of these sessions another time. And I know I'm not going to get through all of the questions because we've run out of time, but I will do one more, because this one came in a little while ago, which was this person often finds that cash flow tools only focus on one client and not a couple's view. Do you have a view on how you should manage cash flow with couples? Ross, do you want to answer that one?
Well, but I mean, the 2 cash flow models that I've used in the last few years will very much take both clients' incomes, expenditures, assets, liabilities, and you get a joint model that takes into account both people's circumstances. So I haven't really experienced the same problem, I have to say, with the model, the software that I've been using, where it's only allowed me to look at one at a time. Okay,
fair enough. Cool. Well, look, I know there's a few questions I didn't get around to. I'm really sorry about that, but I really appreciate all the questions coming in there. It's great to see that level of interaction. As I say, we have got the session on the 7th. If people want to see some of the tools in action, please dial in and join us for that one. We'll be doing another live stream on another topic, probably around workflow and MI coming up in a month's time, so please join us for then. Look out for the invites to that. But other than that, can I just say a huge thank you to Ross and John for a really informative session. Really enjoyed having the chat today. Hopefully the audience did as well, and thank you for so many people dialing in, and virtually everyone staying to the end as well, which shows that you guys obviously kept them all interested. So thank you very much, gentlemen, and at that I shall say goodbye. Thanks all.